Before we start, a critical disclaimer. This video is for educational purposes only. I'm not a financial advisor. Nothing I say is financial advice. Commodities are extremely volatile and risky. Silver can drop 30% in a week. Never invest money you cannot afford to lose. Always consult a qualified financial professional before making any investment decisions. I'm here to present facts, not to tell you what to do with your money. Clear? Let's begin. December 29, 2025. Silver hits $85 per ounce, an all-time nominal high. The precious metals community is euphoric. Social media explodes with predictions of $100, $200, even higher. Then, in 72 hours, it's over. Silver crashes 17%. $85 becomes $72. Billions evaporate. Margin calls destroy leveraged traders. Panic selling accelerates the drop. By January 1st, 2026, the silver market looks completely different. What happened? Why did it crash so violently? And what does China's export restriction actually mean? Those are the questions we're answering today with verified facts only. Let's establish the context first. 2025 was an extraordinary year for silver. The metal started the year around $30 per ounce. By December, it had more than doubled to over $70. That's a 150% gain in 12 months, the best annual performance since 1979. Gold also had a monster year, up 66%, but silver outperformed everything. Why? Multiple factors converged. Geopolitical tensions drove safe haven demand. The war premium was massive. Inflation concerns remained elevated despite central banks' efforts. Industrial demand surged, particularly from solar panel manufacturing, electric vehicles, and semiconductor production. And critically, supply has been in deficit for years. Mines aren't producing enough silver to meet industrial consumption. That structural shortage created a perfect setup for a price explosion. But then came the crash. December 29th. The first catalyst hit. The CME Group, which operates the COMEX Futures Exchange, where most silver trading happens, announced a margin requirement hike. Let me explain what this means. When you trade futures contracts, you don't pay the full value up front. You post margin, which is like a security deposit. If silver futures cost, say, $125,000 per contract, you might only need to post $20,000 in margin. The CME raised that requirement to $25,000 per contract. Why does this matter? Because traders who were already leveraged suddenly needed to deposit more cash. If you don't have the cash, you're forced to close your position. You sell. When hundreds or thousands of traders are forced to sell simultaneously, price collapses. It's called a margin squeeze or forced liquidation event. The CME's stated reason for the hike was risk management. They claimed silver had become too volatile, too speculative, and they needed to cool it down to protect the integrity of the exchange. Critics saw it differently. Some accused the CME of intentionally crashing the market to benefit short sellers or bullion banks who were underwater on short positions. I'm not making that claim. I'm just telling you the facts and the different interpretations. What's undeniable is that the margin hike triggered immediate selling pressure. The second catalyst hit the same day. Federal Reserve meeting minutes leaked. The minutes suggested that while the Fed had cut rates slightly, the pace of future cuts in 2026 would be much slower than markets expected. This is called a hawkish cut. Rates go down, but not as much or as fast as hoped. Higher real interest rates make non-yielding assets like silver less attractive. Investors can earn better returns in bonds or savings accounts, so they sell commodities. Combined with the margin squeeze, this macroeconomic shift added fuel to the fire. The third factor was purely technical. It was holiday season, December 26th to December 30th. Trading volumes are always thin during holidays. Many institutional traders are on vacation. Liquidity dries up. In thin markets, price moves are exaggerated. A sell order that might move price 1% in normal conditions can move at 5% when liquidity is low. Several analysts, including Diana Musina from AMP and Kyle Rada from Capital.com, specifically cited this as a major contributor to the volatility. They emphasized that the crash was magnified by holiday trading conditions, not necessarily by fundamental changes in supply or demand. So, in 72 hours, silver dropped from $85 to $72, 17%, violent, brutal. But here's what's crucial to understand. This crash brought silver back to where it was only a few weeks earlier. It didn't erase the entire 2025 rally. Silver was still up massively for the year. The broader bull trend remained technically intact. Many technical analysts pointed out that the RSI, Relative Strength Index, dropped into extreme oversold territory. Silver's RSI hit 22, a level not seen since the liquidity crisis of 2022. Historically, when RSI gets that low during a bull market, a bounce follows quickly. And indeed, by January 2nd, 2026, silver started recovering slightly, trading back above $72. Now, let's address the elephant in the room. The headlines screaming China bans silver exports. Let me be crystal clear. China has not banned silver exports. Read that again. Not a ban. What China has done is implement an export licensing system. Starting January 1st, 2026, any company that wants to export refined silver from China must obtain a government-issued license from the Ministry of Commerce, known as MOFCOM. This is a critical distinction that most media got wrong, either through ignorance or deliberate sensationalism. Here are the actual facts from official Chinese government announcements. To qualify for an export license, a company must meet specific criteria. First, annual production capacity of at least 80 tons of refined silver. In western regions of China, that threshold can be reduced to 40 tons. But for most of the country, it's 80. Second, the company must have quality and environmental certifications, specifically ISO 9000 and ISO 14000. Third, the company must be in good standing with no compliance violations. These requirements effectively eliminate hundreds of small and mid-sized silver exporters. Only large, state-approved firms will qualify. Why is China doing this? The official reason is resource security and environmental protection. China wants to ensure it has enough silver domestically to meet its own industrial needs, particularly for solar panels, electronics, and electric vehicles. China is the world's largest consumer of silver. Over 50% of global industrial silver goes to China. If they're exporting refined silver while also needing to import silver ores and concentrates, that doesn't make strategic sense. So they're tightening the export valve. The unofficial reason, according to many geopolitical analysts, is leverage. Silver is a critical mineral. The United States designated it as such in November 2025. By controlling access to silver, China gains negotiating power in trade disputes. It's the same strategy they've used with rare earth elements, tungsten, and antimony. Control the supply of materials essential to your adversary's industries, and you control part of their economic future. How much of global silver supply does China control? This is where it gets serious. China accounts for 60 to 70% of the world's refined silver production, not mining. Refining. They take silver ores from around the world, refine them to pure silver, and then that refined product enters global markets. If China restricts how much refined silver leaves the country, global supply instantly tightens. Even a 20 or 30% reduction in Chinese exports creates a massive shortage because the rest of the world does not have enough refining capacity to compensate quickly. Several detailed analyses estimate that if Chinese exports drop by 50%, the global market could face an annual deficit exceeding 5,000 metric tons. That's on top of existing deficits from industrial demand outpacing mine supply. To put it in perspective, global silver production from mines is around 25,000 tons per year. A 5,000 ton additional deficit is 20% of total supply. That's enormous. Now let's talk about what's happening on the ground. Physical silver markets are already showing strain. In Shanghai, physical silver premiums over the London spot price hit record highs in late December. At one point, Shanghai silver traded $8 per ounce above London prices. That's unheard of. It signals desperate physical demand and tight local supply. Similarly, in Western markets, if you walk into a coin shop or check online bullion dealers, you'll notice something. They're not selling American silver eagles or Canadian maples for $72, the current spot price. They're charging $75, $78, even $80. Why? Because dealers know the paper price crashed due to futures market manipulation or forced selling, not because physical silver is suddenly abundant. There's a growing disconnect between paper silver and physical silver. The futures market says $72. The real world says $80. This divergence is a warning sign. Industrial demand remains strong. Electric vehicles require significantly more silver than traditional cars, especially in power electronics and battery management systems. Each EV uses roughly 100 grams of silver. As EV adoption grows, silver demand grows. Solar panels use silver paste for electrical conductivity. Although manufacturers are working on thrifting, reducing the amount of silver per panel, absolute solar installations continue growing globally. Semiconductor manufacturing requires high-purity silver for connectors and components. 5G infrastructure uses silver in antenna systems. These are not speculative demands. They're structural, long-term industrial needs. But here's where I need to present the bear case too. Because not everyone agrees silver is going to the moon. Some credible analysts warn of significant downside risks. First, economic recession. If the global economy slows sharply in 2026, industrial demand for silver could collapse. Factories produce less. Fewer cars, fewer electronics, fewer solar panels. Demand drops, price drops. Second, interest rate policy. If central banks hold rates higher for longer, or even hike again to fight persistent inflation, real yields on bonds become very attractive. Capital flows out of non-yielding commodities like silver and into bonds. Third, peace treaties. A significant portion of a 2025's precious metals rally was the war premium. Tensions in Eastern Europe and the Middle East drove safe haven buying. If major peace deals are signed in 2026, that fear trade unwinds rapidly. Analysts estimate gold could lose $300 to $500 overnight if peace breaks out. Silver would likely follow. Fourth, China could reverse course. Export restrictions could be relaxed, delayed, or interpreted more leniently than the rules suggest. Government policies change. What looks certain today might shift tomorrow. Fifth, and this is critical, we don't know how much silver China actually has stockpiled. If they've been accumulating strategic reserves for years, they could flood the market to crash prices and hurt Western speculators. We have no visibility into their state reserves. That's a huge unknown. Sixth, substitution. Industries are actively researching alternatives to silver. If a technological breakthrough allows for cheaper substitutes in key applications like solar or electronics, silver demand could crater. It hasn't happened yet, but it's a risk. So where does that leave us? As of January 3rd, 2026, silver is trading around $72 per ounce. Some analysts see a path to $100 or higher in 2026. They cite the structural supply deficit, China's export restrictions, strong industrial demand, and continued geopolitical uncertainty. Others see a potential crash back to $50 or $60 if recession hits or peace breaks out. Both scenarios are possible. That's the nature of commodities. Extreme volatility, unpredictable. Here's what you should watch if you're following this market. First, CME margin requirements. If they hike again, expect another flush. If they cut margins, that's bullish. Second, Chinese export data. Starting in February, we'll get the first real numbers on how much silver is leaving China under the new licensing system. If exports drop 70%, prices will spike. If they drop only 10%, markets will yawn. Third, COMEX and LBMA inventories. These are the major vaults in New York and London. Inventories have been falling for years. If they approach critically low levels, we could see a short squeeze where paper contracts can't be delivered. Fourth, industrial demand indicators, PMI numbers, EV sales, solar installations. If these stay strong, silver has support. If they weaken, watch out below. Fifth, central bank policy. Fed, ECB, Bank of England. Rate decisions matter enormously for precious metals. Here's my final message. Silver is not a get-rich-quick scheme. It's a volatile industrial commodity with monetary characteristics. It can double in a year. It can also halve in a year. The recent crash proves that leverage kills. If you trade silver futures on margin and you get caught in a margin call, you're wiped out. Even if you're ultimately right about the direction, the volatility can destroy you before you're proven correct. Physical silver ownership is less risky, but still volatile. If you own coins or bars, you don't face margin calls, but you watch the value swing wildly. That's stressful. Not everyone can handle it. Most importantly, never invest based on hype, headlines, or fear of missing out. Do your own research, understand the fundamentals, understand the risks, and only allocate capital you can afford to lose completely. If you put your rent money into silver and it crashes 30%, you're in serious trouble. To wrap up, silver had an incredible run in 2025. It crashed hard at year-end due to margin squeezes, thin holiday trading, and macroeconomic headwinds. China's new export licensing system is real and will restrict global supply. But it's not a complete ban. The market remains in structural deficit. Industrial demand is strong, but risks are significant. Volatility will continue. Price could go much higher or much lower. Nobody knows for certain. Anyone who tells you they know is lying or deluded. I've given you the facts. I've presented multiple perspectives, the bull case and the bear case. Now you're educated. What you do with that education is entirely up to you. And whatever you decide, make sure it's your decision based on your research and your risk tolerance, not mine or anyone else's. If this analysis helped you understand the silver market better, share it with others who need factual information. Subscribe for more no-hype, data-driven market education. And remember, I'm not your financial advisor. I'm your educator. The decisions are yours. Trade safely, think critically, and never stop learning. Thanks for watching.